folks. This is going to be a special one. And yes, it's going to be a good one. Why? Because I'm going to go over questions and comments from you, the viewers. I love to engage with you guys. We're going to talk about individual stocks, cryptos, geopolitics, personal questions, and a lot more. So buckle up your seatbelts, and here it is. Now, my last video was about cryptos, and I called it a Ponzi scheme. And it is a well-known fact that I am a crypto critic, but we got a lot of subscribers and new followers and viewers who perhaps are crypto investors or crypto enthusiasts. And they did not like what I said, so I have to clarify here and specify my criticism about cryptos. I tweeted this last Friday. I said, new followers and subscribers, I'm not anti-crypto. I'm critical of the asset bubble in the crypto market, rampant fraud, lack of utility and adoption. The blockchain technology itself is immensely valuable, but for now, cryptos are just speculative assets to bet on or against. So again, the asset bubble, I'm critical of that, be it in cryptos or even stocks or real estate, because if you know anything about bubbles, you know that the foundation of any bubble period in any market and in any period of history, by the way, is driven by psychology. The psychology remains the same. It never changes. It is driven by pumping, greed, the drive for get rich quick, and that is the mania phase, and then things stall and start to fall apart because the psychology changes, specifically in face of new fundamentals such as the change in the macroeconomics picture and the change in the monetary policy. So again, you don't have to be a genius to realize the bubbles start and end the same way, be it in stocks, cryptos, REITs. It doesn't matter which bubble we're talking about. The psychology remains the same. And if you spot the psychology patterns, you realize this is another asset bubble and it will end the same way, and that way is crashing. When we talk about fraud in the crypto sphere, it is yet another alarming sign of an asset bubble, and worse, a Ponzi scheme. Why would you need fraud in pumping and recruiting and scamming others endlessly? If you're indeed confident that Bitcoin and cryptos are the future, you don't need to pump, you don't need to attack any critic. You don't need to scam folks to pump cryptos higher. That's another alarming sign, and you see that rampant fraud even in this channel. You look at the comments, all of these bots selling you crypto scams. This is another solid lead that this is an asset bubble that will end up badly. Now, when we talk about the utility versus the adoption, I think a major mistake that the crypto community, specifically in Bitcoin, has committed is the concentration on adoption, not utility. Meaning, the crypto folks have been recruiting, pitching the idea to banks, to investors, to anybody who would listen, and hope that the adoption will drive the value of Bitcoin and cryptos higher. Big mistake. It should have been the utility. It should have been the concentration on utility that would have made Bitcoin and cryptos attractive. No need for the hard sell, because adoption comes hand in hand if there is a successful utility strategy. But this is not what the crypto pumpers did. They were hopeful that the adoption of Bitcoin in a larger scale will drive the value higher, and then they will figure out a utility because it will be too big to ignore at that point. That is the mistake that the crypto community committed, because adoption with no utility is yet another sign that this is an asset bubble that will end up crashing. So again, the crypto community has to think about utility. What is the future of cryptos and Bitcoin? What will they be used for? Because once we know that, we can estimate and pin a value on what Bitcoin should be worth or what a certain crypto should be worth. But as an investor, specifically for somebody like me who handles money for other folks, how can I justify an investment in cryptos without knowing what the valuation is, without pinning a certain value, a certain metric that I can justify the price based upon? So if my investor comes out and says, we're doing great, Bitcoin is up 100%. Do you know why? My answer will be, I have no clue at all. All I know is other people are buying, and therefore the value is moving higher. That is not an investment. That could be a Ponzi, could be a pyramid scheme, could be many other things. Likewise, if my investor comes to me and says, why am I down 50% on Bitcoin? Again, I have no clue. There is no value we can pin that upon. Bitcoin could be worth zero or a million, 100 million, doesn't matter. A trillion, you can pin whatever value you want because there are no fundamentals. And therefore, I cannot buy or invest in cryptos with good faith. When my investors come to me and say why a certain stock is up, why a certain stock is down, I can explain that via technicals, via fundamentals, via earnings, via the macro environment, via the monetary policy. The point is, I have specific things that I can explain why stock went higher or down to my investors. Different story in cryptos because that's not available. So again, I'm not being completely closed-minded. I'm not saying cryptos are trash and they have no use at all. They might have a use someday, but for now they don't. And hence, you cannot really seriously invest in them. And here's perhaps one of the most common justifications of why you should be in Bitcoin versus other assets. The comment reads, I'm only a few minutes in. He's talking about the last video that I produced, but Bitcoin is going to recover to 100,000 by next year. Do you want to bet on that? Do you know for sure that's going to be 100K by next year? Or are you just making that up? If you don't understand this yet, you will forever stay poor when the USD goes to zero. Another bad sign. When so-called investors attack the critic and calling them, oh, you're too old, you don't understand what this is, you're going to stay poor forever. You don't need to do any of that if you're confident about your investment. Meaning, I'm a fan of, for example, Mosiac as a company, as a stock. I don't need to respond to every critic out there of Mosiac and say, oh, you don't understand, you're a boomer, stay poor, bro. I don't really care. I know what the fundamentals are. I know what the company's about to do. I know what the macro environment is. I know what the monetary policy is. Who cares if somebody's critical of Mosiac or any other stock that I like? It doesn't matter to me. If anything, I'd love to listen and hear what they have to say, specifically if it is a constructive criticism, because it might open my mind to corners I did not see. But regarding this argument of US dollar is trash, is going to go to zero because of the printing and the fiat currency and inflation and yada, yada, yada. And therefore, you have to be long cryptos, specifically Bitcoin. My response and rebuttal to you is, why Bitcoin? Let's assume that the US dollar is obsolete, it's going to crash. Why is the substitute to that is for sure 100% is Bitcoin? Couldn't it be another currency, for example, the yuan, the rupee, whatever it is? Could it be another asset? Could it be a specific crypto, not Bitcoin? Why do you say that Bitcoin is or will be the replacement of the US dollar for sure? You're placing all of your eggs in one basket. And since we're talking about the US dollar, here's another question. It reads, old viewer here, thank you so much. I remember you said in late 2020 that you were a short-term dollar bull, but a long-term dollar bear. Is this still the case? If so, when do you think it would be appropriate to short the dollar via proxies? My view on the US dollar back then in 2020 was, all of this money printing will dilute the value of the US dollar, and therefore we have to buy commodities, copper specifically, aluminum, etc. And then came inflation, yet another supportive factor for metals prices to move higher, and yet another headwind for the US dollar. Now you look at the dollar's chart, for example, this is a monthly chart. Right now, the US dollar is at the highest value since 2002. We're talking about over 2 decades ago, almost. However, if you substitute the 8.5% CPI inflation out of the US dollar, it goes down to the same range it has been trading in since 2015. Now you add real inflation, which is at around 20% in this country, and the US dollar is actually trash because it trades down to the same levels since, let's say, 2011, 2010, right around the financial crisis. So all in all, the US dollar took a massive beating from the insane money printing and the insane inflation that we have right now. But the dollar is only strong due to relative performance. What does that mean? Other currencies, other nations, other central banks also printed money like crazy, and now their own currencies are in the trash. So in a room of ugly pigs, the dollar is the hottest, but that doesn't mean that the dollar is not an ugly pig. And the US dollar can ride on this wave of relative strength for a long period of time, because now we have another phase, which is monetary tightening, which means the Fed is ending the insane money printing, at least for now, and the Fed is also fighting inflation, the two headwinds for the US dollar. And therefore, we're seeing the US dollar moving significantly higher, not just due to the relative performance, but also the monetary tightening. But at some point, as we start to head into a recession and we see inflation dissipating, the dollar is going to cool down in a big way. But that depends whether we're going to have a competitive currency such as the yuan, the Australian dollar, the Canadian dollar, the euro, the pound, the yen, one of these has to move significantly higher for the dollar to move down when we get to that stage. Now, when we look at all of these currencies, is it going to be the euro or the pound? Realistically speaking, of course not, because the recession in Europe is going to be deep and destructive. Is it going to be the yen when the Japanese central bank is printing like crazy and easing? Of course not. The only candidate would be the Chinese yuan, but that remains to be seen how China is going to handle the draconian lockdowns. What happens after that, specifically from a monetary perspective, because if all of these currencies remain weak, the dollar is going to continue to hold its relative strength. Another important point that I have to make is, why do you think commodities prices and specifically metals prices continue to move higher even though the dollar was surging higher? Look at oil, for example. Oil moved higher as the US dollar also moved higher. That doesn't make sense, right? It actually does, because the value of the dollar is actually down when you factor in inflation. So yes, you see pauses in the rally in oil and metals when we see the dollar moving higher in a significant way, these massive pops. With that being said, oil and metals continued to rally even in the face of a rising US dollar. Once again, the reason is inflation. When you factor in inflation, the dollar remains weak. It is not at the relative strength where it starts to hurt oil, metals, and commodities. Here's another comment from a friend of the show who says, Maverick, it is hard to decipher your videos. You show the call and put options, but does the market try and do the opposite? Or do we play that information straight? In today's video, you were a bit more clear, but I remember you said you'd let us know when we can short the indices, but you haven't yet. Meanwhile, the Qs has done nothing but fall. Missed a big chance there. I don't know what you're talking about, because here's the thing, I cannot tell you to buy or sell at all, not just from an ethical standpoint or a legal standpoint. But think about it. If I say you should buy now or sell now, that means that I know what the timing of the market is, specifically on a day-to-day basis, and I don't. So it is a little disingenuous to say, hey, folks, you got to buy or sell on a specific time, because I have no clue what's going to happen next, specifically on a day-to-day basis. I can see what's going to happen 6 months from now, a year from now, but not from a day-to-day perspective. And if I did, think about it. I wouldn't be doing this show at all for free. I would be hiding in a bunker somewhere, getting busy, becoming the richest man on the planet. The other point I want to make is, I have been spot on this market, technically speaking, for a long time now. And I made it clear when I was shorting and when I was covering and when I was buying. I wasn't saying you should buy or you should sell or you should short, etc., etc. But look at the chart of the Nasdaq, for example. You see that marking that I'm pointing out right now that says bull trap? That has been placed there while it was happening. Go back to those videos in the same period, around November, October of last year. As the market was surging impulsively so, day after day after day, I said, this is the last hurrah rally. This is a bull trap. We're getting close to the top. The higher they go, the bigger the pullback. And since then, the chart has been consolidating, and look at where we are right now. To my knowledge, I'm not aware of any technical analyst that spotted this from the get-go, that this is going to be the last hurrah and we're done with the run. Matter of fact, when everybody was talking about the Santa rally, I've been critical of the Santa rally. I've been saying it's going to be a trap, and I've made several videos indicating that the Santa rally is fake, and we're going to go down from this point on. I criticized the Santa rally. I said that the wall of worry is too high to climb. I said that the everything bubble is going to crash in 2022. And I've actually shorted the Qs right before Christmas, when everybody else was betting on a Santa rally. And I made that crystal clear on Twitter and YouTube. Take a listen. This is going to continue here, because 397 is the center of gravity. It will act exactly as 313 before. The problem is, if interest rates continue to move higher, I don't know if the center of gravity will be enough to keep the chart from falling down further, specifically when the big caps start to melt. Let's follow up on a trade that I had right after Christmas, or before Christmas, I should say. I said that I'm buying puts on the Qs, or initiating a short trade, at around 397. So batch number 1 happened at 397. What do you know? The Qs moved higher. And then we had the pattern, the resistance, making lower highs. On the third lower high, it became evident to me that we will visit 397 sooner or later again, so I initiated batch number 2 for that particular trade, buying more puts. Batch number 3 will take place if we have a confirmation of a rejection at 397, meaning if the Qs open down tomorrow, far away from 397, then we'll know right away that the chart got rejected from 397, and therefore I will initiate batch number 3, and that will complete the trade, and we will wait till expiration date, which happens to be March. Now, in all likelihood, the trade will be closed before March, the expiration date, if we see a flush down in the Qs. But this is how you construct the trade, on increments, because you'll never get the timing right. So you have to open your trades on increments. And this is exactly how I do it. So again, the market gave you multiple opportunities to short exactly at the top, which a lot of my viewers did, not because I told them they have to, but because they listened to my reasoning and my analysis and they came to the same conclusion. And I've been on the hunt, by the way, for a top before it happened in the Qs. And again, I spotted that exactly at the top. Once again, take a look. This is an hourly chart for the Qs. And forgive me if the details are difficult to read, but the point I'm trying to illustrate here is, look at the RSI. Every time on the hourly chart, every time we have traded at these levels, the Qs pulled back. Matter of fact, the pullbacks range from 1% to a little over 7%. The question is, how far down will we go when, not if, but when the pullback happens? For that, we have to investigate the components of the Qs. And here it is. Since then, the Qs went down by almost 29.5%. And that was exactly the top, right there and then. When it comes to the daily chart of the Qs, the continuous contract, while the so-called Santa rally was going on, I was keeping my eye on the big picture here, and I guided you step by step to the importance of 15,975. What happens if that line was broken? Take a listen. We had the sloping, descending line of resistance. We were expecting that the resistance will work this time around and we will see a pullback. It didn't happen. The momentum is so strong, the volume is too low, the path of least resistance is higher. They managed to break above the descending line of resistance. Of course, we have the all-time highs as the next target. The momentum indicators are getting stronger. We have a confirmation on the MACD, and here is the bullish scenario. And this is typical behavior of any chart, by the way. When you have a double bottom versus a sloping line of resistance, and you break above that line, you're gonna go down to revisit that line and confirm it for support, and then the chart rebounds higher. This will be the bullish scenario, of course. The bears are hoping for something different. The bears are hoping that this is a false breakout and the chart will pull down to revisit 15,975 as support and perhaps pierce below that. So the take here is, watch how this chart's going to behave. It's going to pull back. When it pulls back, what will happen to that sloping line of resistance, now support? Will it bounce back from that line or will it fail to bounce back? If it bounces back, then you know you're going to buy the dip because we have higher highs. If it fails to do so, then you know 15,975 will be the next stop. I will take it from there. Now, let's take a look at the daily chart for the continuous contract for the Qs. What we're doing right now is retesting that sloping line of resistance, now supposedly support. We're retesting this one as support. We came close in the previous candle, but it did not retest that level exactly. Today, we retested that level and closed above it. Is that enough to conclude that the Qs are positive? Because it is a positive formation. It is a bull flag formation. Not really. We have to see a confirmation. Another day, a bounce higher tomorrow will confirm the sloping line of support is solid. However, if we open down tomorrow, losing that support and perhaps revisiting 15,975, then you'll know the bears are starting to take the advantage here. The momentum indicators remain positive, but they're curling down, and look at the volume blasting higher on a down day. The bears are turning the tables here. And right there and then, that was the confirmation that we got a top and you should hold on to your shorts, to your puts, until things change, until the technicals change. And I've been holding on these puts all the way till we spotted that we're closer to the bottom. And I identified for you 3 points where a bottoming might happen and where a rebound rally is going to start. Take a look. What about a daily chart for the continuous contract on the Nasdaq? Why do I have 1, 2, 3? I was supposed to do a show yesterday. These are my notes from yesterday, but let's catch up. Number 1 is support number 1, which is the trend line in yellow, as you can see. And today we got to bounce exactly from that. If that doesn't hold, then we have support number 2, which is the low of the last bottom, which is around 13,026. And then if that doesn't hold, we have the last support at around 12,766. If that doesn't hold, then cue the animal with the fire, cue the nuclear bomb, cue the end of the world. For now, the momentum indicators are still within negative divergence. The volume spiked higher on a down day. All of these are good signs for the bears that perhaps we have more pain to come. But we haven't seen the bottom in this chart yet. Keyword yet. We have a rebound from target number 1, which is the yellow trend line. We could go to target number 2, which is the previous low, but we're not there yet. We have the support 13,300 intact. On top of that, look at the volume. It is receding below average. You combine that with the VIX, and you could make a solid argument that we're seeing the sellers pretty much maxing out. We're seeing sellers' exhaustion. If the sellers stop selling, the buyers will show up, and we will see all of these charts moving higher, including this one. Because the bulls would argue, if we switch to a line chart, we have a sloping line of resistance. But we're also seeing a saucer bottoming formation. We're seeing higher lows. We're seeing the selling drying out, and hence the saucer bottoming. Sooner or later, this chart will find its way and break above the sloping line of resistance once again. All of that. And of course, we played call options, buying individual stocks, buying the indices, and then came the time to short again. And I tweeted this. I gave you the Kim Jong-un nod on April 5th. 2022. The Qs lost 3 important support lines, and I made a video about it, and I told you I'm shorting. I'm back in the Q puts. And since then, the Qs went down by almost 22.5%. Now, the only mistake that I did throughout this journey of shorting and covering and then shorting again the Qs is on April 25th, I said buy the dip. And I covered my short in the Qs, and I started buying calls on individual stocks. And of course, we all know what happened. Since I bought, we got a rebound, followed by consolidation in a high volatility range, very wide range. So again, that was the only mistake that I made, but I corrected it quickly. And this is what I said. I gave you the support and resistance lines, and I identified if this support is broken, you're gonna go short. Take a look. But this is a wide range. We've been going back and forth for a couple of weeks now. We need to see the resolution of all of this. Either the chart climbs above 13,599, that'd be a signal to go long, or we see the support of 12,766 broken, that would be a signal to go short. And here it is, since 12,766 was broken, the chart of the Qs went down by about 8.5%. So yes, I got the misstep of covering and then buying some calls, but I quickly spotted the error and I changed course again. And then in the last video, I announced that I closed the puts. I'm done with the shorts for the Qs for now because I've seen certain things indicating a short covering rally to come. And you know what happened on Friday, a massive rebound higher. So far, I mean, you're not going to get to 100% accuracy, but I think I did pretty good. I will never tell you to buy and sell. Instead, I'm going to do the work. I'm going to do the analysis. I'm going to tell you what I'm doing, and then it's up to you to do whatever you see fit. Here's the next question. It says, could you cover Netflix tomorrow? Let's do Netflix right here. A massive crash, no doubt about it. This is one for the books. A lot of pain for Netflix investors, and the reason is we have erased, 3-4 years worth of rally in a few weeks. We're down to the same level the stock was trading at back in 2017. Now, back in 2017, the valuation was 10 times the revenue. Right now, the valuation is around 2.7 times sales of last year. Now, you could say, wait a minute here. The stock is extremely undervalued. It's a buying opportunity. Yes and no, because at the end of the day, it is in the eye of the beholder. Back in 2017, this was a growth company. This company was expanding its revenues and net income dramatically, so there was an excuse for 10 times revenue. Likewise, the monetary policy was easing. Print, baby, print. No problems here. We can justify a 10 times revenue in a growth company easily. But now, a lot of things changed. Number one, the company is not growing anymore. The company is not only stagnating, but it is shrinking. It is losing subscribers. The cash flow went negative. And now we have questions that perhaps this company reached a growth ceiling. A growth ceiling means revenues, net income will stagnate. And now the growth phase is behind us, and the company has to shift strategies into efficiency and how they can increase the net income by reducing costs rather than expanding the revenue, as in any growth company. Now, this is a bad outlook for Netflix because at best it's going to be a stagnated company, and with the streaming war, they cannot really cut costs that much. On top of that, the Fed is tightening the monetary policy. So the stock market puts 2 and 2 together and says maybe the fair valuation for now is 2.7 times sales, if not lower. So be careful of falling into a trap of looking at the chart and saying, oh, look at that, Netflix is so cheap, it is oversold, let's buy right now. Well, let me tell you something here. You're not going to see these highs, the 700 plus in Netflix, you're not going to see this perhaps in years to come. So if your goal of buying Netflix right now is let's go back to the moon, it's not going to happen. If your goal is I see value here, I see the market being too harsh on Netflix, I see the last quarter as a hiccup, as perhaps washing away the excess with the pandemic period. And then we go back to the same trend of growth that the company was at before the pandemic. If that is your thesis, then sure, you can buy Netflix now, but you have to have an investment horizon of 5 years plus. And you shouldn't think that the stock is going to go back to 700. It might go back to 300, might go back to 400, but that's going to be a process, and it's going to be a boring investment. So you have to use your head here. Now, when we talk about the fundamentals, the upcoming catalyst, the upcoming tailwind is when Netflix announces ads. You're going to see short covering, you're going to see buying of the stock, but ads are not going to solve the problem that Netflix has. The problem is not growth anymore, because growth will reach a ceiling sooner or later, and adding ads to expand the revenue could actually fire back, and the company could lose subscribers, and we see cannibalism, where one avenue of revenue takes the other, and net the company loses. The problem with this company is engagement. You got to keep the viewers engaged, because the longer they're engaged, the higher the value they're getting from the platform, and the more willing they are to pay more for the subscription fee, or perhaps to engage in pay per stream for certain content, and that could be another avenue to expand the revenue for the company. But again, the problem is engagement. How do you keep the viewers engaged and hooked up to the platform? You got to produce not just good content, not just engaging content, but content that develops habits, viewing habits. And this is where my criticism of Ted Sarandos begins, because yes, when Mr. Sarandos took over Netflix, he changed the content. He brought excellent content to the platform, but he did not figure out how the streaming business works. He thought if he produces blockbuster movies in Netflix, paying hundreds of millions of dollars in producing that content, or producing content that's going to score with the critics and give Netflix awards, or perhaps just good content. Here's the problem. Tastes vary, and I might get something good from Netflix once a month, once every 2 months, 3 months, maybe once a week. But again, what happens in between? You're not using the platform. You're not being engaged. And at some point, you might say, hey, wait a minute here. I'm not really using Netflix anymore. Why not just cancel the subscription altogether? I'm going to reactivate the subscription once the content that I'm waiting for arrives. Now, Netflix might say, hey, we're just going to do an annual subscription fee where you can't pause or cancel. That's going to fire back, because it shows a company that is desperate, not innovating. The answer is engaging the viewers. What kind of content develops daily viewing habits? Think about this channel, for example. You know what to expect. You're getting a show every single night talking about the stock market. Here's a habit. The viewers anticipate the content to come out in a certain time, and they know exactly what they're getting, and that keeps thousands of viewers engaged in YouTube's platform. Different story in Netflix. You watch the Ozark in a single weekend and you're done. Now you got nothing to do, because the rest of the content is not appealing to you. So again, to Ted Sarandos, you need to develop daily viewing habits, content that produces daily viewing habits. Think about game shows. Think about nighttime shows, podcasts. Doesn't matter what it is, so long as it is produced daily and keeps the viewers engaged and hooked to the platform. Now it becomes harder to cancel your membership, because the content you're waiting for is going to arrive in a month or two, or maybe next year. Now you have to keep the membership because you got a daily viewing habit. You're engaged in the platform on a daily basis. Now, do you really think that Ted Sarandos even understands what I just said? Of course not, because he comes from an entirely different world. The world of Hollywood and awards and critics and what the LA Times is going to say, not what actually works for the platform. Anyhow, here's another question that reads, could you look into used car companies like Shift, Carvana, Vroom, ? I would love to hear your input in these. Nope. I'm not touching any of those names right now. These are the names that you should have invested in back in 2020, 2021. Back when these companies had inventory. Like Carvana, like CarMax, they had an inventory of cars, and that inventory was appreciating in value every single day due to inflation and the insane demand on used cars. What happens after they sell all of these cars? Well, now they have to replenish the inventory by buying used cars at inflationary prices. So their advantage, poof, gone. And therefore, you're seeing these stocks crashing. Be it CarMax, be it Carvana. Look at Carvana. I mean, this is a massive crash, erasing the entire gains from the pandemic. And now we have 22.16, the previous low. Perhaps you want to wait till that happens before buying. Now, you're going to see short covering and massive pops in Carvana on day-to-day basis. But for now, I would avoid the auto dealerships, the used cars dealerships. Forget about those right now. They lost an important competitive advantage. Maybe that will come back later on when the recession happens and they start scooping these cars at pennies on the dollar because folks in a recession losing their jobs, they cannot afford the car anymore, etc., etc. For now, a better investment would be auto parts stocks. Why do I say that? Because think about it. You have folks who bought all of these used cars. They paid a lot of money for them. Used cars are going to have mechanical problems. Have you noticed what the mechanics are charging these days? An arm and a leg. Unbelievable. So you're going to see a lot of folks fixing their cars at home, and they need to get parts. Even if you take the car to the mechanic, they need to buy parts. And therefore, I'm bullish on auto parts stocks for now, but not the dealers. Here's another question. We were talking about Alcoa and aluminum, and somebody said, you're buying Alcoa now. We talked about this stock multiple times in this channel. And I said I'm going to talk about it over the weekend, but let's go back in a reminder on where I got into Alcoa, because that is important for the perspective. So take a look. For Alcoa, one of the top performers this year, a classic inflationary stock. We have a shortage in aluminum. The prices of aluminum are exploding higher, and therefore we have a great setup, fundamental setup for this stock to move higher. It already moved higher, triple digits, and now what? We're seeing all of these inflationary stocks pulling down double digits, 10, 20, even 30% in certain cases. And the main question is the inflationary trade dead? The answer is, in my opinion, not really, because we still have the fiscal spending to come in terms of infrastructure. So watch out for this name. It's a bullet stock. What is a bullet stock? It's a stock that works when we have pricing wars, when we have severe competition in certain industries. You go back to the source, the provider of the bullets, not the stocks involved in the war. We have an EV war. Well, all of these EV manufacturers need aluminum. We have an infrastructure bidding war. All of these firms will compete to get a contract from the government. Well, guess what? Alcoa provides all of that aluminum regardless of who wins the contract. And therefore, it is a perfect bullet stock. Now, let's talk about the technicals. We have a consolidation range, a descending channel consolidation range after a massive move higher in the stock. This is a bullish setup, not a bearish one, and the stock is already breaking above the consolidation range. We need a confirmation this week. Well, the confirmation happens, then the stock will move higher, perhaps creating higher highs once again. We see the double bottom formation in the momentum indicators, the RSI, the MACD, indicating that the stock is ready to move higher. The momentum is already bottomed and it is ready to build on again and move this stock higher. My expectations are Alcoa moves higher. And here it is. Since then, the stock shot up higher by almost 168%. And then it crashed down after the last earnings report, which we covered in this program. Now, point number one, this is an illustration of the importance of buying put options. When you have certain stocks in your portfolio that ran really high and you're about to receive an earnings report, understand this: the stock is pricing a lot of good things. If the report comes out negating, even by the slightest margin, these good things, you're going to see an oversized reaction to the downside. So you always have to buy puts in the stocks that ran really too high in your portfolio right before earnings. Point number two, when we look at the chart right now, we have a trend line. This is a weekly chart, and we have an important support line at around 57.5. For now, the chart is keeping both the trend line and the support of 57.5. So if you want to buy, this is the time to buy, but you got to keep in mind an important thing. Number one, we're heading into a recession. I cannot recommend to buy any stock when we're heading into a recession. So if you're going to buy right now for the first time, do it via call options. You buy calls, let's say 60, 65, whatever number you think is appropriate. Let's say with the expiration date of June, July. If the chart doesn't go above your strike price, then you'll know this was not a good deal and you only lost the premiums for the options. You did not lose an investment. You also have the support line and the trend line to look at. If these are broken, then it's probably not a good time to buy. If you are a shareholder of Alcoa, like me, the way to buy it right now is via selling put options. So I sold the 50 put options, and if the chart goes down there, then I have the option to either exercise and buy the stock at $50, add to my shares, or just buy back the put options and move on if the stock is going to go down even more. When it comes to the fundamentals, all in all, the bearish thesis against Alcoa is, number one, the volume is down. So we're seeing a slowdown in demand. That is the assumption for now. And the assumption goes China is under lockdowns and therefore the demand for metals is dying, and you're seeing a drop not just in aluminum prices, but also in copper, in tin, in zinc, in even lithium. And the question is, will China be under lockdowns forever? Perhaps. I've heard news that China is canceling events in 2023. So yes, there is a possibility that the Chinese economy, the biggest consumer of commodities, could be locked down all the way to 2023. And that would be bad for metals and bad for Alcoa. But here's the counter from the bulls. Number one, you have the aggregate demand. What does that mean? It means that all of these auto manufacturers who are shifting to EVs and producing new assembly lines, they need a lot of aluminum to produce these cars. The demand in the pipeline is immensely high because a lot of folks are ordering, but the manufacturers are struggling to produce new cars because they're missing chips, they're missing aluminum, they're missing rubber, they're missing a lot of important parts to produce these cars. That doesn't mean that the orders or the demand is slowing down, at least not right now. Now, what does that mean? It means that there is a put in aluminum, for example, meaning if the prices go down too much, too fast, you're going to see the manufacturers ordering more because they're taking advantage of lower prices while the demand that they have in the pipeline remains high. You see, when a recession happens, the number one stocks that you want to pick up is stocks of companies or commodities that have strong and healthy aggregate demand, meaning if prices go down, the demand increases. And this is the case for aluminum for now. Number two, the bulls will also counter and say, well, look at the inventories. The demand is sky high, even without the Chinese participation. Yet the inventories are nowhere to be found. If China opens up at some point, they're also going to add to the demand. Meanwhile, supply nowhere to be found. This dynamic is supportive for higher prices of aluminum, and that would be a bullish case for Alcoa. So again, you have two opposing sides. The bears say the Chinese lockdown is slowing down demand a lot. We have a recession coming. Why would you buy Alcoa or aluminum right now? The bulls will counter and say, well, we got the aggregate demand, so we have a put on aluminum, but we also have a lack of inventories. Those inventories have to be replenished. And again, that supports the put in aluminum, where prices are going to be higher for a longer period of time. And hence, that is bullish for Alcoa. Weigh in both sides, look at the technicals and the charts, and make up your own mind. But for me, the way to play it, I sold some puts because in a risky market with a recession on the horizon, you gotta be really careful, and using option strategies is the way to go. Here's another comment that says, I work at Owens Corning. Goodbye, no supply chain problem there. Had the best quarter ever. I work in insulation, the board kind. Look, it is a great company, so your job security, even if we have a recession, your job security is really high because you work at a great company with excellent financials. I mean, you look at these numbers. They're gonna make over $9 billion in revenues this year alone. The profits, they're surging, almost $1 billion in profits, net income last year. When we look at the balance sheet, it's excellent. They have twice as many assets as they have liabilities. When we look at the cash flow, it is positive. It's moving higher. They produced over $1 billion in free cash flow last year. On top of that, the valuation for this company right now is really cheap. When we look at the price to earnings ratio, 8.5 right now. The price to sales, about 1 times. So you're paying exactly what the company produces in sales. And the price to cash flow is around 6.3 times. This stock is really cheap, and it is outperforming financially speaking. There is a reason why OC did not go down while the entirety of the stock market crashed, or home builder stocks absolutely got creamed. But OC continues to hold on because, as I've said before, the aggregate demand for these housing supplies is still here, meaning you also have a put on roofing, piping, carpenting, all of these housing supply stocks. Why? Here's the answer. The nation is short about several million homes, meaning sooner or later we have to build these homes. The demand is too high, the supply is nowhere to be found. Now, in a recession scenario, you're going to see folks losing their jobs, dumping their homes, getting out of mortgages. You're going to see these criminals, these investing companies who are scooping single-family homes in American suburbs. They're going to fold and dump these houses, so the supply is going to come out. But that doesn't solve the core problem in the housing market, which is the fact that we're short millions of homes. Millions of homes have to be built in this country. So yes, the home builders might pause the construction under unfavorable times, such as in a recession, for example. But even in a recession, if the prices of these insulation and roofing supplies and piping supplies go down, guess what? These home builders will take the advantage of these lower prices and buy. So there is a put These prices are not going to go too low. You're still going to see strong sales in Owens Corning even under a recession because these home builders have to buy the supplies anyways, and they're going to take advantage in buying them while they're cheaper than right now, for example. So yes, I do like the stock. I never worked over there, but I hope you're happy. It's a great company from what I hear and what I know. Here's another comment that builds on the same housing theme. It says, I heard from this dude who sells retail lumber. He said word on the street is the critical part of new housing starts is slowing fast, specifically pressure treated 2x6. The first piece of wood. No starts the finish, right? Question mark. Have you heard anything? I'm hearing the same thing, and I've been hearing it for a while now. The home builders are finding a hard time finding all of these supplies because they're not being sourced. Whether that's China, whether that's the ports, whether that's the thing, whether that's the insane demand, doesn't matter. The result remains the same. We're short in supplies. So again, do you want to be with home builders or do you want to be in the stocks of these supplies companies? The roofing, the piping, the nuts and bolts, etc. I'd rather be with the bullet stocks, not with the home builders. Now, when we talk about the shortages of supply right now, what happens under a recession, for example? Well, the demand is going to cool down, allowing the supply to catch up with that demand. So we will see more production of roofing supplies, piping supplies, nuts and bolts, etc. Unlike other goods and services and commodities, which suffer under a recession because the demand goes down, plummeting really fast, and it takes a while for this demand to recover. Unlike all of that, when we talk about piping, roofing, housing supplies, the moment these prices go down, the home builders, the aggregate demand is going to kick in, and they will buy all of these supplies because they need them desperately, and hence you got to put in housing supplies. Here's another comment that says, see, when he talks about his own holding, Mosiac, he can do actual supply and demand analysis and conclude high inflation is ultimately temporary. I don't know what you heard over there. You probably heard what you wanted to hear because this is what I talked about. I said that Mosiac has unfulfilled demand. The demand is too high. The supply is nowhere to be found. Now, is this disinflationary? Of course not. It is inflationary. It means that these prices of fertilizers are going to continue to move higher so long as the demand is still here. And from the results that we got from Mosaic, the demand is too hot. They cannot even find the supply to fulfill this demand. Now think about it. If you're China, for example, or India or Saudi Arabia, and you're buying fertilizers from Mosaic, you place the order. Are you going to cancel at some point when they say, oh, there is a recession? Of course not. Under a recession, the most important thing you want to do is feed your population. So again, there is a put on fertilizer prices that if they go down too low, you're going to see the demand kicking back in, and you're going to see these kind of assets recovering faster than others, even under a recession. But regarding your question, the supply-demand dynamic in Mosaic is actually supporting for more inflation, not less. So I don't know where you got that inflation is peaking or temporary in this case. Here's another question that reads, so you don't believe in the large short interest that AMC has, question mark. Don't they have to cover at some point, question mark? Well, the short interest right now is at 19.5%, which is not a lot, by the way, for a company this size. Now, unfortunately, there is a lot of misunderstanding of how shorting works. And there is this new generation of investors who got engaged in the stock market right after the crash of 2020, and they got duped in these meme stock schemes, which, by the way, I don't believe that the rise in meme stocks, GameStop and AMC in particular, was due to organic participation by the retail investor. I don't believe that at all. I believe this was organized effort by hedge funds and the likes to pump these stocks higher and use the retail crowd to do it. But there was a lot of misinformation, a lot of misunderstanding of market dynamics by the retail crowd. A lot of them thought it was cool to buy GameStop and AMC because they saw massive pops, and it became a story, became something that everybody's talking about. So they wanted to be a part of the action. And of course, the motivator in this case was stick it to the shorts, stick it to the man, to the hedge funds. They're shorting these stocks for a while, and if we all buy all of a sudden, we're going to induce a short squeeze where the hedge funds have to cover their shorts and lose a lot of money. And the retail crowd got caught in this without really knowing how things work. You see, the majority of the shorts in AMC shorted when the stock was at 30, 20 bucks, and then the stock went down to less than 5 bucks. So when there is a short squeeze and AMC moves to 10 bucks, 15 bucks, 20 bucks, you have a huge chunk of shorts who are still sitting at profits. Number one. Number two, I've been shorting stocks for a long time. You don't really get margin called if you know what you're doing. And in a small stock like this, you're not really incentivized to cover your short. You're not going to be forced to cover your short in most instances because what you can do is add more cash and the hedge funds have no problem getting more cash, or you can sell certain stocks that you want to sell anyways, and you can cover the margin. And you know that this is a hype story that's going to fade away sooner or later. So if anything, they're giving you another opportunity to short once again. And therefore, you did not see a lot of short covering in the meme stock rallies. There was some in GameStop, but not a lot in AMC, because GameStop has a higher price value than AMC. Matter of fact, the SEC did an investigation. They said that the majority of the pop that you saw in GameStop and AMC was not due to short covering. It was due to the stampede of buying by the retail mom and pops. But this is a massive mistake that the retail crowd did. They got hooked up in the story that buying GameStop and AMC will give them a lot of profits. Oh, on top of that, they're sticking it to the man. Not really. False on both ends. It cannot make money in the long run from a company that is on the verge of bankruptcy, even if you have a stampede of buying. That's a hype. That's not an investment. Number two, the sticking it to the man part, for the most part, that didn't really happen. And it was just a selling point for whoever orchestrated this pump in GameStop and AMC and meme stocks to use to lure the mom and pops to get engaged in this pump. So again, to answer your question, the shorts don't have to cover. They can hold on to the shorts forever, so long as they're paying the interest and maintaining the margin requirement. And most hedge funds are pretty good at doing that. Very few hedge funds that get caught with their pants down and they get margin called and they have to cover somehow. The bottom line is your investment and trading activities should be based on the merit of each company, the macroeconomics, the monetary policy, but never on hype, on stories, or short covering. Because guess what? Buying stocks and shorting stocks is a healthy part of any market. Shorting is not evil. Shorting is not bad. Shorting is a part of the stock market, an essential part of the stock market. It keeps checks and balances in the stock market. Could it be abused? Yes. We've seen many instances of that, but so is the abuse of pumping stocks higher. Why do we complain about shorts manipulating stocks down, but we seldom complain about hedge funds and the Fed and the likes pumping stocks higher based on nothing, creating pumps and dumps schemes? It works both ways. And by the way, I made a lot of videos during the heat of the AMC pump, and I was critical. I said it's not going to end well. You're going to lose all your money. We're closer to our top, etc., etc. And the apes were vicious, by the way. Look at these comments in these videos. They were vicious. They did not understand what I was seeing back then, but now they do. And the lesson is, do not invest in hype. Always use the fundamentals, the technicals, the macro environment, the monetary policy to lead your decisions. Don't get caught in feeling that you have to have loyalty to a certain company or a certain CEO or a certain group, because at the end of the day, in this market, every man and woman on their own. Matter of fact, I don't like any of the companies I invest in. I think they're all criminals. I hate every CEO that I'm investing in. All what I care about is making money. Putting money at the table at the end of the day. That's all what matters. I don't care about the company. I don't care about the CEO. I care whether they deliver to my portfolio or not. And if they don't, goodbye. I'm dumping the stock. But this new generation of investors, they have loyalties to the CEO. They've been worshiping Adam Aaron, the silverback. Meanwhile, he doesn't give a shit about you. He cares about himself. He cares about dumping his own stock, taking advantage of your stupidity to get rich. They worshipped, in the case of Palantir, Alex Karp. Look what happened to them. Alex Karp walked out filthy rich. They did not. They're cheerleaders for certain stocks. They created groups, the apes, etc. All of that is stupidity. You don't owe the stock, the CEO, the company, anything. They owe you when you invest in them. They got to show you the money. They got to deliver on the financials and the fundamentals. If they don't, goodbye, not interested. Here's another question. It says, hi Maverick, if you see this, could you please comment on the trading volume in the S&P 500 for today, meaning Thursday? It looks way off the charts. What's going on here? I appreciate it and thank you for the wisdom. The volume was high, no doubt about it, and it indicates lots of short covering. Now, whether that short covering is going to be sustainable or not, that's a different story. I gave you 4 conditions for us to know that this is a solid, reliable bottom that we can work with. Number 1, short covering. Number 2, retail participation via options, buying calls. Lots of calls. Number 3, the 10-year yield has to go down. These levels right now are just too high. Number 4, the US dollar, most importantly, has to go down. The dollar has been insane. It needs to go down. But at least we got one sign that the shorts are covering for some reason. Maybe they're anticipating a comeback of China, for example, if the lockdowns are removed. I don't know what they're seeing, but on Thursday they covered. And the evidence was the massive spike in volume. Now, can we read too much into it? We better not. because if we do, we're just going to confuse ourselves even more. We have to wait for confirmations. Oh, we're getting closer, by the way. Here's a question and a comment about the EU and NATO. I made a video about the European economy, saying that it is on the verge of collapse. It is falling apart. The commentator says, what are the benefits of even being part of either NATO or EU at this point? If I were a smaller European country, my main goal would be to secure gas, oil, food, and a peace treaty with Russia. The EU is a failure, and NATO is nothing more than a money pit. You're right on everything you said here. You see, the European continent has been always dependent on Russia for resources for hundreds of years, and that's not going to change. So whatever the Europeans are doing right now, this cute move of let's gang up against Russia and see what happens, no good things will happen. A, you're going to damage your economies severely. B, you might risk a war, a massive war, World War III, and that's not going to be good, not for the economy, not for humanity at all. There is no good thing that will come out of World War III, not at all. Folks keep saying, oh, but we need to get rid of Putin, and that is worth it if we go to World War III or even a nuclear war. Here's what you don't understand. This country has over 6,000 nukes. At least 2,000 of those are ready to go at any moment. What makes you think that removing Putin will get us something better? Because believe it or not, in Russia there are hawks who are saying right now that Putin is too weak because he's not using the nuclear threat as he should. What makes you think that removing Putin out of the office, that his replacement will be something better? In my opinion, it's going to be 1,000 times worse. Russia is a tough country. If your expectations are Putin goes away and some hippie, pro-Western Russian takes over, and we fix all of these problems, he or she will denuclearize Russia, and they're going to be friends with the West again, these are just fantasies. Russia's a tough country to take over. Russia has a unique history, a unique culture of respecting power. No Russian will respect a weak leader who's going to sell out to the West. So whoever takes Russia after Putin, in my opinion, is going to be 1,000 times more vicious, and they're going to be loose with the nukes. This is not an outcome that we should be even entertaining at any point. We have to come at peace that Russia is always going to be a nuclear country, and for that we have to work with them, not antagonize them all the time and risk a nuclear war. That will be the end of humanity. Nothing will be left out of the US, Russia, or Europe. Yet today we have these babies, these naive morons on Twitter and social media, even on TV. We're not talking about some Gen Zers who have no experience or no knowledge of history at all. We're talking about seasoned media personalities. We're talking about retired generals who are casually saying, oh, there's no risk at all in upping and escalating against Russia because they're too weak. Oh, and they're never going to use nukes at all. With the same mouth, they say that, oh, Russia's a massive threat. If we don't stop them now, they're going to take Poland and Germany and Hungary and everything else. Well, wait a minute here. You just said that they're too weak to take over Ukraine, let alone taking over Poland and the rest of Europe. You say that Putin is never going to use nukes, and we should continue to poke him and escalate even more so we can induce the most damage to the Russian military. Yet with the same mouth, you say that he's unstable and crazy and losing his mind. Which one is it? Because if he's crazy and losing his mind, I would not trust this guy not to use nukes. But the bottom line here is, yes, all of this doesn't make sense at all. All of this will produce massive economic damage to the European continent and the rest of the world. Because you have a country like Brazil, for example, that feeds a lot of nations across the world, from South America to Africa to Asia, all over the place. Brazil is a commodities giant, but they rely on fertilizer supplies from Russia. Well, we now have sanctions on Russia, so they cannot really import the fertilizers. We're going to see a massive drop in crops across the globe, which will produce a hunger, starvation, if not a famine. Is it really worth it to do all of what we're doing right now? Risk a famine, risk an economic collapse globally, risk World War III, risk nuclear confrontation for what? To get rid of one guy that we don't even have a replacement for, that we don't even know the replacement for, whether it's going to be better or worse? That is certainly something to think about. But unfortunately, we have babies, children, leading the conversation right now in our governments, in our media, in our social media, and you're not even allowed to present a counter view or say, hey, wait a minute, what about these things? They shut you down right away and say, oh, you're a Russian propagandist. You're working for Putin. What a bunch of morons. Now, if you want me to expand on this history and go back on what I really think about NATO, what I really think about what's going on, let me know in the comments. I don't want to do it right here because I'm going to show you a lot of facts. We know the sheepies, the geniuses, they don't like a lot of facts. They just make emotional, impulsive decisions and they go with the main narrative. What are we doing this week? We're hating on the non-jabbers, the Canadian truckers. Oh, we're hating on Putin now? Russia? Okay, we'll go with that. Just keep moving from one issue to the other with no thinking at all. So again, if you want to hear my views and details, let me know in the comments and I'll do that in a separate video. I don't want to do it here. Here's a comment by the viewer. It says, Jerome Powell did say the party's over and over and over again. Yikes, he yelled it out at the podium. You know what, my friend? You're right. You're 100% right. We should cut Jerome Powell slack because he did warn us. He did warn us that the party is over. Yet the geniuses didn't want to listen at all. They said, oh, Jerome Powell is bluffing. He's going to ease again. Buy the dip, bro. And I told you, by the way, long time ago, they're never going to stop until they lose all of their money because they're gamblers. And gamblers never stop. So yes, Jerome Powell gave us a warning, I believe, back in September. And I produced a lot of videos. I said Jerome Powell from dove to hawk. He's going to slaughter the dip buyers. I said, don't fight the Fed. Remember, don't fight the Fed? And then I said, epic bull trap in the making. Why would you want to fight Jerome Powell? Jerome Powell in the financial world is a heavyweight with 10 black belts. Really want to fight this guy? Of course not. Specifically when Jerome Powell doesn't even have a clue of what his policy should be. He says he wants to fight inflation like Volcker. Then he says 75 basis points are off the table. Which one is it, Mr. Powell? And the more confused the Fed chairman is, the more confused all of us are going to be, the more confused the stock market is going to be. So yes, Jerome Powell gave us the warning. But the rebuttal would be he kept moving back and forth. He lacks confidence. He's not being assertive. Taking these 75 basis points off the table is going to give the gamblers and the speculators what they need. That the Fed is bluffing, the Fed will never raise interest rates, the Fed is actually going to ease, and they're going to continue to buy the dips over and over and over again and get slaughtered over and over and over again. Because inflation is what dictates this conversation, not Jerome Powell. Jerome has to react to inflation, and inflation is going to force him to become really aggressive in tightening the monetary policy. Here's another comment that says, Mav, I love the classic video references, though you do know the Gen Zers may not get it. Believe it or not, the Gen Zers are actually really savvy when it comes to movies and references because, after all, the Gen Zers are the streaming generation. They can access content on demand, and to them, it's new when they watch it. For example, for you and I, Pulp Fiction is really old, but for a Gen Zer watching for the first time, well, that's new. They can do the references and that becomes relevant again. So you have movies that we watched and they died a long time ago, or TV shows that nobody cared about for years, all of a sudden becoming relevant again. That's the magic of streaming and the availability of content. So the strategies from these companies have to change. You have to realize that old content could be relevant once again. How do you monetize that? Memes, products, etc. But do you think these corporate geniuses know any of that at all? Of course not. They care about the stocks and their bonuses and what they make, and that's all there is. They're not creative enough to capitalize on the fact that you got an entire generation. For them, old content is new, and there's a lot of money to be made from that point along. Now, if you happen to be a Gen Zer, let us know in the comments, and let us know whether the references that I use are too old for you. That'll be really interesting to find out. Although I have a hunch, the Gen Zers are really savvy about movies and TV shows, old and new. Here's another comment from the viewer. It reads, I love you, Mav, but I think you're evenly harsh on Elon's intentions sometimes. He's a brilliant guy, but I don't think there is as much crooked or evil intent as you portray. He has plans for sure, but I think there is good intentions. Just a random guy's 2 cents. Look, I think I've been fair to Elon Musk. I'm not a fan, I made that clear, not a fan of Elon, but when he does right things, such as buying Twitter and according to him, I don't know if he's going to do it or not, but he says he wants to make Twitter a free speech platform. Okay, I'm supportive for that, 1,000,000%. And I praised Elon in this program, and I know that the pitchforks are coming for him. They want to destroy Tesla stock now. They want to come out after his reputation. There was a disgusting hit piece in the New York Times suggesting that Elon is a racist because he was born in South Africa. It's absolutely absurd. That doesn't mean that there is not legitimate criticism of Elon Musk for how he treats labor, for example, labor conditions, from his close ties to the CCP in China, from his lack of emotional IQ, and creating pumps and dumps schemes like Doge and Shiba. A lot of folks lost money in those. And of course, his obsession with Tesla stock, which caused him to lie and manipulate facts and weasel around to keep the stock higher. And he's pumping the stock, luring more investors in a pyramid scheme, because that's what it really is, and he knows it. Otherwise, he wouldn't be dumping billions of dollars right at the top. So he knows that the folks who are buying Tesla stock right now will end up losing their money, and perhaps they're not going to be able to recoup this money for years to come, if ever. So yes, he is manipulative, he's a liar, he's a cheat. There's a lot of criticism, legitimate criticism, against Reverend Elon Musk, and I keep that real in the show. But when he does right things, such as free speech, for example, then I'm a fan. I'm supportive of that. So I disagree with you, my friend. I think that I'm more than fair to Reverend Elon Musk. Here's another comment that says, Cathie Wood has a nice head on her shoulders. Okay, to each his own, I guess. Another question that says, what firm you work for and how much do you charge your clients if I want to be one. Now, I can't talk about my work a lot because I got in trouble before, so I only talk about it when it's necessary, such as, hey, I'm not making a show tonight because I gotta work. I mean, you have to know that, but I'm not gonna give you the specifics, not because I'm trying to be secretive or anything like that. It's what they want. Their point of view is, you do whatever you want to do when you're not working here. You want to do a YouTube channel, that's fine, but that's you. That's not us. So don't associate us with your analysis, your work, your comments. And frankly speaking, it is because I'm a loose cannon. I'm a free speech kind of guy. And I criticize the Fed. I called Jerome Powell a criminal. I called JP Morgan's CEO, Jamie Dimon, a gangster. I criticize politicians in the harshest way. I called frauds and scams in the stock market. I accused the SEC of being in a coma. All of that's not going to make friends for you in the financial industry. So again, I'm really respectful of the separation, what I do in my full-time job and what I do in YouTube. Sometimes these two kind of collide and they overlap, and I have to address that. But besides that, I keep it separate because I am respectful and understanding of what they want or what they think. But at the same time, I'm a free speech kind of guy. I'm going to say my opinion, whether it's right or wrong, that doesn't matter. It is my opinion, and I'm showing you how I got to that opinion. Some people agree, some people disagree, and that's that. But what I do is portfolio management for a selected group of investors. This is a boutique firm, once again, that I work for. It doesn't have a lot of clients. We don't get accounts, lump them together, and then dump them at BlackRock or Vanguard and send a statement at the end of the month to each investor. That's not what we do. We do the white glove VIP treatment. You got a portfolio manager on demand. We have managers for fixed income, certain stock market strategies, like growth portfolios, value portfolios, commodities. So we serve each need of our investors. If they want to be in commodities, you got the commodities guy. You want to be in fixed income, you got the fixed income guy. I'm a diversified portfolio. That's the official title. But what I tell my clients is I follow the macro and the monetary cycles, and I invest based on them. And each manager has a few group of investors that we keep in touch with every single day. I don't have a lot. We don't have a lot in general because we want to maintain that white glove approach. So these folks are very high net worth. They want the white glove approach. They want a manager on demand that they can speak with who produces in-depth reports and analysis about opportunities in the stock market, the changes in the macro outlook, etc., etc. And the recruiting process is really selective. Like we don't need clients. We don't have a pyramid scheme here. We don't need to continue to recruit people. We just need the right investors, and that's it. So there is not a lot of recruiting that goes on. But then I share my opinions and my views in this program, and hopefully it benefits more people. I'm not right all the time, but I try to be. I try as hard as I can to produce a thorough analysis every single night. So this is the only way for now that you can take advantage of me. But for now, we're not recruiting. We're not adding more clients or anything like that at all. And this is a good segue to the last question, because it is kind of connected. The viewer asks, is there a subscriber count where you would consider doing YouTube full-time? It is not about the subscribers count. That doesn't really matter. I mean, you can have 1,000 subscribers and you can make more money than somebody who has 100,000 subscribers, for example. What really matters is the views and the engagement, most importantly, because you need to keep your viewers engaged. For example, if your viewers watch a video and by the end they click on another video that is suggested, that's counted as engagement. So you make more revenue that way. Another point is the viewing duration, because when you have your viewers engaged for a longer period of time on a regular basis, the channel makes more money because you're giving YouTube highly engaged viewers for a longer period of time, meaning YouTube can sell more ads. So again, it's not a subscribers count. It's not really what I'm thinking about here. Do I want to be a full-time YouTuber? Of course, because I mean, is there a better job than this one? Of course not. I mean, this is my passion, and you can see it when I talk about these issues. Whether people agree or disagree with me, they can feel and hear the passion that I really like what I'm doing here. I'm really engaged in the analysis, and I truly have a passion for the stock market and macroeconomics, etc. So yes, I'd love to be a full-time YouTuber. The problem is, it gets really complicated because, believe it or not, YouTube doesn't pay a lot of money. That's the ugly truth. If you want to make this a real full-time job, you got to have an enormous amount of views every single day. And even if you do that, what guarantees do I have that that's going to be sustainable? For example, if YouTube drops the rate I'm getting paid right now, for whatever reason, if YouTube decides to ban the channel for whatever reason. The lack of job security is the problem here in becoming a full-time YouTuber. I'll be taking a lot of risk dumping my job, which I like a lot, which pays me a lot, and then doing this full-time, taking the risk that I could get demonetized anytime, I could get dumped anytime, and the pay is a lot less. That's a lot of risk, and it is irresponsible, specifically if you have a family, and I do have a family. Now, the other avenue to become a full-time YouTuber is crowdfunding. There is a lot of risk with that too. Number one, you lose your independence because now you work for the people paying you. What if the people paying you are a bunch of crypto nut jobs? Am I going to become a crypto fan all of a sudden to appease the people who are paying me? Of course not. You got to remember this. This channel pretty much alienated the majority of investors out there. I've alienated the meme stock investors. I've alienated the crypto investors. I've alienated the big tech and software investors. I've alienated the RKK Cathie Wood investors. That's a huge chunk. That's not even interested in being in the channel. So what would the reception be if I do turn to crowdfunding? Number one. Number two, even if that works out, you lose your independence because now you're working for a certain group of people. Whatever they believe, whatever they hold, they got to cater to that. You're not going to be just you, which was the magic behind making this channel appealing to those folks who find it appealing, because I'm just being me, saying whatever I think, whatever my analysis leads me to. So that's the risk of losing independence. And again, we go back to the same point, which is, do I leave a job that I really like, that pays me handsomely, and take the risk to become a full-time YouTuber? That's something I got to think about carefully before I take any decisions. But it does really bother me a lot and stresses me a lot that the content is not getting out in time. Because number one, the East Coasters are not happy. The videos come out, midnight time? Everybody's asleep. And that leads us to number two, losing half of the country. So when folks ask and say, how come this channel doesn't have 100,000 subscribers or 1 million subscribers? Well, we're missing out in half of the country. So the benefit would be, if I become a full-time YouTuber, is at least getting that content earlier, the East Coasters. But folks, again, it's a lot of risk, and you got to be really responsible when you have a family. You can't take lots of risks when it comes to career decisions. That doesn't mean that I'm not open-minded to it, but right now, it's not the time, at least not for me. All right, we've done a lot of questions, a lot of comments, a variety of topics. I hope you liked this video, and if you did, should we do more of these Q&As? Maybe on Saturdays, Fridays? We just do Q&As, comments. If you do think that's a good idea, let me know in the comments and we'll do that from this point on. Now, here's the bad news. This is the only show you're getting tonight, so I'm not going to produce another video with the technical analysis and all of that. We'll catch up on Monday, but the take for now is, I gave you 4 conditions for the sustainability of any rebound or bounce higher. We're seeing some good signs, and the technicals improved in the charts, but there is no confirmation yet. And what really worries me about the rebound that we got recently, in the last couple of days, in trading of course, is the fact that the rebounds are huge in individual names. We're talking about 20-30% in certain instances. That's a lot in a short amount of time. And it fixes the oversold conditions quickly in the technicals. And it's also a pattern of bear market rallies. So the bottom line for now is, Monday, we're looking for a confirmation. We'll see what happens. But for now, this is all I got for you. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.